Welcome to Scope's Portfolio Manager Conference. I'm your host, Manqing Sun, mutual fund analyst from Scope Analysis. For this session, I'm very pleased to be joined by our guest speaker, Matthew Moberg, Portfolio Manager at Franklin Templeton Investment. He is joining us on the line today from San Mateo, California. Good morning and welcome, Matt.
Hey, Manqing, how are you?
I'm doing good, thanks. Our discussion today will tap into growth stocks primarily in the US market and explore opportunities in innovative companies. The session aims to address questions that's been on investors' mind recently, for example, the inflation, looming tapering, hiking rates, and supply disruption. I'm also going to ask Matt to share his take on valuation, especially during this earnings season, and perhaps get down to some names there. I'm sure the audience also very interested in hearing the latest and hottest trends in the Valley to get some inspirations for investing. Before we begin, I'd like to remind you with few logistics. We'd love getting your questions, so please keep them going throughout. We will do our best to answer as many as we can. A webinar replay will be made shortly after the live event. You could rewatch the clip on our Scope Explorer website or in the video on demand section at any time you want. So before we dive deeper, let me first introduce our speaker today, Matthew Moberg. Matt is portfolio manager of Franklin Innovation Fund, the top A-rated fund launched in 2019, significantly outperformed since inception with an annualized return of 35.7%, well above its peer group at 16.6%. Matt is also lead manager of Franklin Dyna Fund, launched since 1968, which is considered as U.S. equivalent of the Franklin Innovation Fund. He has industry and company 10-year experience of 23 years. Am I missing anything, Matt? Do you want to tell us a little more about yourself?
No, that is great. That is all accurate. I'll fill in some parts of that though. So I've been at Franklin for over 20 years, and I actually started in 1999, being lucky enough to cover the internet space, which was a really exciting time to cover that space. And for the next 10 years, I covered internet, and then internet and video games, and then internet, video games, and software, and then finally media as well. And in 2004 is when I started working on this fund called the Dyna Fund, and that's really where I sort of learned this art of investing in innovation. And by way of background, I actually graduated from college as a history degree, and I really had a great interest in history, and just always found that really fascinating. And I think as we talk, or as you listen to me talk, you'll hear that I sort of interweave history a lot into the conversation that we have. But I also got my CPA, which is Certified Public Accountant, so I really wanted to have sort of this right brain, left brain exercise. But it was in 2004 where when Rupert Johnson, who's the vice chairman of Franklin Resources, contacted me and said, listen, would you like to learn how to invest in innovation? And I would like for you to learn with me as we invest together in this fund. In the U.S., it's called the Dyna Fund, and now the Innovation Fund. And of course, I wanted to learn this journey. And so what we really learned and developed together over the next almost 20 years now has been a process that is a repeatable process of how to invest in innovation. And one thing I akin it to is I actually like watching these movies about how to climb and climbing movies. And there's this movie, if you haven't seen it, it's called Meru, where they talk about climbing mountains. And they sort of say that if you want to be a great climber that climbs these great mountains like El Cap in Yosemite, or in this particular movie, a mountain called Meru, you actually learn in the climbing gym. And you actually go to the climbing gym, and that's where you sort of learn your base moves. But once you start going outside and attacking these big walls, you really need a mentor. That mentor tells you what time in the morning to wake up, when the rock is actually the driest so you don't slip, what type of weather that you can climb in, what you can't climb in, what type of things to bring, etc. And I really view my experience as very similar to that, in the sense of I got this base knowledge in MBA and history and getting my CPA. But then working with Rupert and going through that sort of mentorship, where he had already had over 40 years experience, and then I'm learning from him, was really similar in that way. And there's a lot of industries like that, actually. In semiconductors, if you want to be an analog chip person, you actually just go to a good university, and then you sort of join one of these analog teams, and they sort of teach you how to manage and how to build analog semiconductors, but you don't learn that in school. And so I really viewed sort of school as the equivalent of the climbing gym, and then working with Rupert, sort of actually learning how to climb those big walls. And I think that analogy holds as far as how my experience has gone. And now I've been doing that for 18 years or so, and so it's been it's been a lot of fun.
Yeah, I remember during our rating interview, you are very passionate about European history, and I think it's an extra point for a very well-rounded profile for as a PM on the strategy. And I believe history can actually offer a lot of advice and inspirations. So even if you're looking ahead and to find innovative companies. So let's talk about current situation. We just finished the first down month since January for many equity markets. There's a lot riding on it. Negative earnings revisions, at least for the S&P 500. Supply disruption lingers, and labor constraints. Growth stocks, suffer apparently from the moving rate. What do you think is the largest driver in terms of change in sentiment currently?
Yeah, we certainly just went through this experience where many of the technology stocks, in particular, or really, I should broaden that and say many of the innovation stocks, had kind of a unique demand profile through COVID, and in many cases, things were pulled forward, meaning demand was pulled forward. And that demand was pulled forward. Now I think we're sort of lapping that in some areas, like in e-commerce, for example. And so what we try to do is we try and look at sort of what the 2-year growth rate is. You're correct. In this earnings season, we did see some companies not report or guide for as strong, of earnings as we might have expected, or what we've seen historically. And there's a handful of reasons for that: supply chain and other things, which I think we'll get into. But I think what's important is to take a further step back, because when we invest, what we're really trying to think about is what's happening over sort of the next 3, 5, and 10-year time horizon. And even though we're absolutely trying to sort of capture data points by what's happening in the quarter, we always have this long-term view. And what our long-term view is right now is that we're going through a period that's very similar to the second industrial revolution, which we saw, in the late 1900s, early 20th century. At that period of time, what we went through was a period of time in which we had a handful of platforms all develop at the same time, which was very unique in history. And those platforms happen to be things like the combustible engine in the car, which led to steel and rubber and the oil industries. Also, another platform was electricity. We also had telephone and telegraph. We also had some small platforms which were idiosyncratic, like photography and those types of things. But what you experienced during that time is sort of this level of wealth that had never been seen before in history. And I'm still talking about the late 1800s, where the most famous names, at least in America, were names like Rockefeller, Vanderbilt, Ford, etc. And we think we're going through a period that's very similar to that today. And so when we're trying to think about what we think is happening, in what period of time that we're in, we actually try to think about it in longer arcs. And when we try to think about it in the longer arcs, because we think that's the way you invest in innovation over the long term, we really would say we're going through what Klaus Schwab, who founded the World Economic Forum, would call the fourth industrial revolution. And there, if you think about who are the biggest names today, and we are also seeing these trillion-dollar market cap companies, where these people like Bezos and Musk and Zuckerberg are worth more money than we've ever seen, in our lifetimes. And in addition, they've created these incredibly valuable trillion-dollar companies, really in one career. I would argue that there are so many in other words, 10 to 15 people. There's $6 trillion companies, or almost $1 trillion companies right now in the U.S. market. That's very rare that you have those created in such a short period of time. I think you could also argue these people like Musk and Bezos, they're incredibly young. They're in their 50s, 40s. Zuckerberg's 37. And so to be able to create that much wealth in such a short period of time is one indicator that we are going through a very unique period of time. And there's a lot of different platforms of growth that are all concurring at the same time. And so I think that's how we think about it, more than what happened sort of in the last 90 days. That's more of our outlook, is to try to think about in 3 and 5 year periods.
Yeah, actually, I think when we look at the consumer sentiment, I mean, in the U.S., for example, it's consumer is probably one crucial sector for U.S. economy, and it all comes down to disentangle this supply and demand. I mean, the demand is strong, like the consumer saving is robust. People are willing to open their wallets, but we are having this disruption in the supply chain. So the challenge here is actually in timing. If it turns out that the third wave of COVID variant is going to improve, and so will the job market, and all these will ease into a healthier, more sustainable recovery. So, and these weaknesses are actually transitory. So fundamentally, does it mean that now is yet another opportunity for investors to buy the dip?
The way we would try to phrase that is, we do believe that these supply chain issues that are occurring right now are transitory in nature. But what is transitory? How long is transitory? I mean, I probably would have started saying it's probably a few quarters. It feels like now it might be 4 or 6 quarters. It's really hard to tell. However, I think that the pace of technology is really accelerating. And so we actually do think that technology is going to solve a lot of these problems, and a lot of the problems that we're experiencing, in particular with the supply chain, for example. I mean, let's take just a simple example and say, if you were a trucker today, a long haul trucker, a short haul trucker, frankly, today, your business is going great. And it's just very easy to find work. You probably get to cherry pick, which routes you want to run and that kind of stuff. And your wages are probably going higher. However, if you took a 10-year view and you happen to be a 30-year-old trucker, I would be concerned about what the future looks like with automated driving and automated parking and other things, and even rails becoming much more efficient using technology. And so I think what we try to always sort of separate is this idea of what is temporary and what is permanent change. And we're trying to invest on the side of what is permanent change, because what we want to do is sort of take these 5 and 10-year time horizons out. So in that example, and that just happens to be a very specific example, but I think it's illustrative of what we think is going on in the economy. From our perspective, it doesn't really matter to us whether or not this is a 2-quarter thing or if this is a 6-quarter thing. In my opinion, the supply chain issues will get rectified. If there's profit in rectifying them, the economy is going to figure out what those bottlenecks are. And then we need to think about, how much change is happening in the economy over the long term. And so that is, I think, how we would take about it. And so one thing we're always discussing just internally on our team is, what is semi-permanent or permanent change, and then what is temporary, and where we want to invest is where that semi-permanent or permanent change is occurring.
So I guess the biggest question right now facing U.S. stock investors is whether the elevated valuation is there to stay after many years of bull market. How strong for how long? And if we take Peter Lynch's rule of 20 into consideration, market-wide PE plus inflation should equal about 20 to be a fair value market. And here we got PEs way above 20, and inflation's on a high level. Is this the time that when valuation is coming down, cooling markets, that a correction is imminent? And in that case, at what magnitude and when to put a top on that? say?
Yeah, I think we would try to. I think the way we would think about this is because, as I mentioned, we're sort of going through this period of what we would sort of say is this area of really high disruption and high change in the economy. Um, and the way we've tried to phrase it, actually, to try to help people organize just the amount of changes going on, we sort of developed this idea of having 5 platforms. And what these 5 platforms try to do is they try to illustrate the amount of innovation happening in the economy. So the 5 platforms we have are disruptive commerce, and genomic advancements, intelligent machines, new finance, and then the last one is this idea of exponential data. And so the reason why I mention that is because there's a few things. One, it just helps organize what our thoughts are. And then I think, secondly, it illustrates how cross-industry all this innovation is. We're really talking about retail, healthcare, industrials, finance, energy, and then in technology. And so one thing sort of is our outlook, and when we're thinking about valuations, we think we're going to go through a period which we would call sort of a K recovery. A K meaning that there are going to be very big winners, and then there will be bigger losers than what we've had in the past. And so K, like the letter K. And there are going to be some old and established companies that have been around for a very long time that are not going to be able to cross this chasm of the amount of change that's happening in the economy. And we're already seeing it in the US. We've had these companies like Sears and J. Crew and Neiman Marcus. These were big retailers, for example, that haven't been able to cross over. There have always been high valuation stocks. That has simply been part of investing in the market. What our job is to find those companies that are undervalued. And so we understand that right now, from a PE basis, that the market looks more expensive, but we think it's due to a handful of things. We think it's due to the fact that there are new innovations and new companies coming out, and the way in which sometimes when you start a business, the profits don't necessarily show in the trailing 1 year, but they actually show further out. One thing that I've covered Amazon.com now for over 20 years, and during that entire period of time that I've covered, excuse me, Amazon, it's been a very expensive stock. It feels like that's like an asterisk on its name is Amazon.com, comma, very expensive stock, did the following this week. Amazon, in particular, has been in the news feels like almost every day for the last 20 years, and so has Netflix and others. And so there's some sort of mispricing that's going on in the market for the general press to think that these are such expensive companies, and yet at the same time they've been some of the best investments in the market. And so we spend a lot of time trying to think about that valuation and why there is that separation. And in our opinion, the reason why there is that separation is because there are 2 things that the market doesn't always understand, and that is either the duration or the pace of growth. And the duration is really this idea of how long can growth continue in excess of GDP. And in many cases, that can be 20 to 30 years. Facebook is still growing, well above 20%. Salesforce.com went public in 2004 and has never had a year, including the financial crisis, where it's grown under 20%. And so you have these companies that are able.
I was waiting for you to move
ahead.
forward to the Tesla,
Yeah.
because we have a question received from the audience saying, does the valuation of Tesla worry you?
Yeah. So okay, so I can go into Tesla in particular, and I'll stop where I was speaking. Yeah, so on Tesla in particular, we own it in the portfolio. We haven't been adding to it. We do think that there is a very reasonable scenario in which it's worth as much as it is today. And I think one of the things that's being misunderstood by that company is it's not just a car company. It also has software on top, and therefore it can get operating margins that are actually similar to Apple Computer. What they will do is they will not only sell you a car, but then they will sell software on top of that, and that software you'll pay for. For example, $10,000 for ludicrous mode or something along those lines. And so we actually think that it's not unreasonable that Tesla is a $1 trillion market cap company. We do need to build a long-term, discounted cash flow in order to do that. But if they can get 20% of the market and be at 25 to 30% operating margins, and then that doesn't include some of the solar parts of their business, we think that company can be worth this valuation. However, as these companies continue to increase in value, sort of the wiggle room, if you will, or the chances of something going wrong do not get priced in as well, making the investment less attractive. And so right now we're from our perspective, we're a little bit underweight Tesla. We've owned it and we still hold it. We just haven't been adding to it.
Okay, so I guess you covered already a lot about that, but I still gonna ask you, like generally, how do you factor those into your stock picking strategy to ensure, high multiples are for good reasons? Because we see people are beginning to draw parallel to the tech bubble rally, looking back, where are we now? And could you give us some examples?
Sure. So again, I think we need to take this sort of longer term time horizon and try to think about, what is this idea of, like, how long is the duration of growth of some of these companies? And so if we take that into consideration, we think we're seeing some tremendous values in the marketplace, and there's been some tremendous change. So I'm going to give you sort of one historical to sort of explain like what we try to do, and then I'll give you one sort of more current. So historically, like, what do we try and do is, in 2004, we actually initiated our position in Apple Computer. Apple Computer at that period of time, the thesis behind it was this idea that because the iPod is so successful, it's going to sell more Mac computers. That was our thesis in 2004. It feels incredibly outdated. And Apple was a PC company, basically competing with a PC company, selling at 50 times earnings. And that felt incredibly expensive, irresponsibly expensive at that time. You fast forward to 2014, we actually ended up, that initial purchase, we ended up buying that at 0.5 times earnings because the company grew so much during that decade. And so we're trying to find companies like that today. So, so what are some of the areas where we think we're seeing some of those undervalued assets that are in that way? I mean, one of the areas that's really come through during COVID is this area of genomics. And in genomics, we've seen, two of the best therapies, which are the Moderna and the BioNTech therapies, really be accelerated in this vaccine production and this mRNA get accelerated. Not only is it accelerating in the science itself, but consumer acceptance, government approvals of these, individual vaccines has accelerated. And that means there's a lot more venture capital that's going to go into this space. And so when we think about who's really benefiting from this change that we've just seen, we think that there are companies in that space, in that genomic space, that are incredibly inexpensive, not only on the therapeutic side, but also on the equipment side, and also on the contract research organizations or the CMO side, which is the manufacturing side. And so we are now manufacturing a lot more genomic material. We actually think that that's an area that has growth over the next 10 years. And again, you can find companies that optically look expensive, using the trailing 12 months earnings profile, But if they're really able to grow over the next sort of 7 to 10 years, they look incredibly inexpensive. And so I think that's how we try to think about that in between these when we're trying to think about what's happening in valuations and that type of thing. Manqing, I think you're on mute.
Oh, sorry. So I was looking at the question that our audience is submitting. I mean, you could cover it shortly, and we can maybe talk about it more if we have time. So the question is, what is your view on the thesis the world is developing towards a bipolar technology world that is led by US, the Western Hemisphere, and the Chinese Hemisphere? I know that you are also like your strategy. You primarily you invest in the U.S. Stock market, but you do have some exposure to like global growth stocks, right?
Yeah, sorry, I didn't understand the question exactly. What is the what? Can you repeat the first sentence that you had?
So what's your view on the thesis that world is developing towards a bipolar tech world
Ah,
that is led on one side by U.S. Western Hemisphere and the
right.
Chinese Hemisphere?
Okay. If we are entering into sort of a yeah, a sort of a Chinese hemisphere and then a Western hemisphere, um, I don't think that's necessarily bad, and I think it's already sort of occurring. China's had the Great Firewall of China, the Great Wall, that has been in existence really for the past 10, 15 years. Google left China over a decade ago now, and those companies, those big companies like the Alibabas and the Tencents, et cetera, they've benefited from the fact that China has tried to create its own internet industry and been very successful, and so in doing so. And there's been a lot of innovation out of China, but it also gets repeated in the West. In other words, just like China takes some of the best ideas from the West. Um, West will take some of the best ideas in China, particularly in like consumer internet, where China's been a real leader. I think in the area where you actually end up sort of being on the side of benefiting is if we have, and we're starting to see this, if we have two semiconductor supply chains, then the equipment companies benefit because they're building a lot more than what they were doing before. And so in some industries, it actually benefits them. And so we're seeing, big announcements of capex and of big semiconductor plants being built in Japan, as well as in Europe, as well as in the United States. And so that's really an effort to make sure that we're not as reliant, the West is not as reliant on what's happening in China. And then China also wants to build its own semiconductor industry, so it's buying capex. And so there are areas that are actually benefiting from both of these. And then I would argue the areas that you might be concerned about competition, there hasn't been competition. So it's really a no change. So as odd as this sounds, but from an investment perspective, I feel the fact that there's sort of these two parallel economies that might be sort of growing up now and not interacting. It from an investing perspective, it might be a little bit better on the margin, and or no change. So that's kind of our view on how that works.
That's very, very interesting. I think if we had time, I would certainly like you to maybe address more on that. But first, let's talk about inflation and rising rates. There's been a change in the narrative about inflation that goes beyond transitory. Yes, inflation is going to be elevated, but it's going to lift earnings and thus will not impact the multiples. Now that the earnings season will be reality check for this lofty valuation. Do you agree with this narrative? For investors, what to expect?
Yeah, as it pertains to inflation, itself, what happens when you're in an inflationary environment is we're going to have to raise rates. Um, what, and so what we try to look for is companies that have pricing power. I think that's what's most important. And we factor that into our consideration when building an entire portfolio to try to think about how does the portfolio take advantage of higher interest rates if they happen. However, and even though that is the case, we actually are, our opinion on inflation is that we continue to think that we are going to be in a relatively deflationary environment. And the reason for that is because technology continues to be very deflationary, and we think that that will continue. I mean, an example of that is what happens in Uber when you're able to increase auto utilization from 2% where it is today to 3%. You're basically able to add no capex, and you're actually able to make the global auto fleet 50% more productive. That's actually very deflationary. The same with something like an Airbnb, where you can have more conferences or something like this in a city, but you don't have hotel prices go up because people overflow into Airbnb. And so, and then when you think about factory automation and other things, I think technology is getting large enough to actually affect the economy and be deflationary. And so our general view is that we understand that with these supply shocks, et cetera, of coming back from COVID, that we might go through a temporary inflationary period. But it's our expectation that technology is becoming so pervasive that we will continue to be in a deflationary environment. And the last comment I'll mention on that is a lot of these things don't get picked up by the traditional economic metrics. I mean, it's very hard to look at, hotel rooms, including Airbnb, to figure out, why aren't hotel prices rising, or to figure out what auto utilization is and why that's affecting things from from that perspective. So it is our view that we're sort of going to continue in a long-term deflationary environment due to the advances in technology.
Mhm. So maybe a follow-up question to that, as we are approaching year end, how true is that active management is potentially, going through some pressure to chase performance, given that market has done so well this year, and what does that mean overall for the market?
Yeah, I just simply don't have a 90-day. Well, maybe we might be shorter than that. We're in November, but I don't have a 60-day sort of forecast. The way we try to think about it is longer term than that. I understand that there is. I mean, I think you're absolutely correct in the assumption that window dressing is a thing. Historically speaking, the winners throughout the year sort of end up doing well towards the back half of the year, and all that. And I think that is a phenomenon in active management. However, if you're trying to take that sort of 5, 7, 10-year view, we actually try to take that noise and try to put that aside, and then try to make what we think are intelligent investments of companies that really have this duration of growth behind them. I think one thing I would say is one work we did with the U.S. fund is we said, how much does timing matter? If you had invested in the U.S. fund in January 1st of 2008, your timing would have been a nightmare. Your first year, you would have lost 40% of your money because you would have hit the financial crisis. But if you had a 10-year time horizon, you actually would have enjoyed, by investing in innovation, you would have enjoyed a 10.2% annualized return. You would have beaten the S&P on average by 170 basis points per year. So if you have that longer term time horizon, then I think trying to understand what's going to happen over the next, are we going into a recession, or what's going to happen in the next, 30, 60, 100 days becomes less important. And what's more important is, do you have the ability to have that duration of capital where you invest it over the whole cycle? And it's our opinion, if you're able to invest it on the whole cycle, then you'll should be able to outperform the market by investing in innovation. That's how we think of it.
I guess that we've covered a lot of topics from general market macro perspective, Matt. Your fund is looking at companies based on bottom-up fundamental research. So what is the current situation there in the Bay Area? Do you still have like indoor mask mandates, or are you back on the road again for client meetings?
Yeah, well, we're hybrid. So, in our office, we are, now able to return to the office. I would say
Mhm.
the office about 20% full. And then in January, we are supposed to all return back to the office. Um, I was actually in Europe a lot this summer. I would say that it's actually very similar. We do go through different waves at different timings. So there does feel like there's periods of time where there's sort of a lockdown and then relatively things open up. We're very fortunate in California to be in California where the weather is such where you can have classes and things like that outside in general. But
Mhm.
I would say it's very similar. People are wearing masks, and there's general respect for COVID. But I would say we're at the point where we are living
Mhm.
with COVID instead of afraid of COVID.
Mhm. Have you been talking with the management of the companies, company visits, doing anything like in the valley?
Yes, there are still management visits, still insight, and management visits, and that's or on-site manager visits, and that is starting to happen more.
Mhm.
And so it's starting to open up. Where we have
Yeah.
Eli Lilly coming to our offices
Oh,
today,
okay. Mhm.
and then we're going to visit other companies, on
Mhm.
their respective campuses. So that's happening. That's starting to happen.
So based on these meeting, what's your impression? What are their comments on the recent supply chain bottleneck? Are they worried? What's the message that you're getting? How do you invest around that?
No, I would say everyone is aware, but I would argue that from the companies that we're meeting and talking to, everyone is of the same belief that it's temporary and it's something that is going to be worked through. Listen, it's not that surprising if you have sort of a factory that during COVID completely shut down and and shut down for almost a year, where during that period of time, all those people that either were laid off or were not coming into the factory, whatever, many of them reevaluated their lives. Many of them got very good benefits, and so they don't want to come back to work. Many of them are afraid to come back to work, and some have moved. So you don't just pick up the phone and say, let's just bring the whole band back together. You actually have to hire new people, retrain new people. And so I don't think it's just the supply chain. I think it's on the factory floor and then it's transportation as well, where the bottlenecks are. And I think it's very reasonable that it happened. But I also think that, from the management teams that we speak to, um, it's something that's going to be managed and managed through. But you do have more, for example, on the factory floor, you'll have a lot more newer employees, for example, and they have to be trained and they have to go up that sort of learning curve that you go up when you start a new job. And so from that perspective, it's very reasonable. And I have not heard any, panic or deep concern, but I've heard companies trying to manage it through the Christmas season, that type of thing. But we think that at this point, it all appears to be very manageable.
Mhm. So the way you approach your research and your meeting with clients is to identify long-term trends. What are the themes you see that will carry us forward, as you always like emphasize that it's through like 5 years, longer periods? Maybe some of the stories that you can share there, and where else than US you see potential?
Yeah, I think one way to think about this is and try to think about what's happening next is to think of this idea of the atom, the byte, and the gene, and that is those are the three things when you talk about the physical world, the atom, and then the informational world, which is in the byte, and then the key to all life, which is the gene. And we've really spent the past 20 to 30 years trying to get the byte, which is information, down into its smallest form, which is sort of a 0 to 1, and be able to securitize it, store it, transport it as efficiently as possible. And now it's really amazing. I mean, we don't have tape deck storage or anything like that anymore. We're able to file videos and stuff right at the edge of the cloud, and so we spent a lot of time trying to think about how to move that byte very, very quickly. And so the result of that is actually that we start getting cloud computing, we start getting artificial intelligence, we start getting virtual and augmented reality, the metaverse, all of that. And I think that particular investment arena has lots of space in which to run, but it also has been an area that's now something we've been working on for the last 20, 30 years, since really the advent of the PC. So if we go and we say, like, what's kind of interesting going forward, I would say it's probably the atom and the gene. That is actually when you start taking, in the case of the atom, when you're actually able to build things at its smallest form, at the atomic level. And in semiconductors and some new materials, we're actually able to do things at that precise level. Never before in human history have we been ever to build anything from that atomic level. However, that's just starting. And then same with genomics. And where that really happens, if we try to think about what's going to happen over the next 20 years, we start to think about not just our sort of data world, like what we see in front of the screen has what's been changed, but the physical world that we live in will start to change. And that can get, that starts to get, in our opinion, sort of very exciting. We're talking about companies that are able to, in many cases, when we talk about sort of things at the atomic level, beyond semiconductors, we start talking about machines that are getting just much more intelligent, and that can really start in the healthcare space. It can start with, blood sugar monitoring, where, everybody who eats something can have a different reaction from a blood sugar level. Bread might spike my blood sugar level, but it might not spike your blood sugar level. And so you can actually have a monitor on you that uses artificial intelligence and doesn't just, you don't just prick yourself 2 times a day, but instead is able to monitor yourself throughout the day, really 24/7, use algorithms and artificial intelligence to be on top of that and really understand what sort of triggers you to have sort of insulin spikes. And so we're going to see tremendous improvements in healthcare, in preventative healthcare, and then, of course, in that genomic space that I mentioned, and I've already sort of talked about that a little bit, but we're going to see tremendous advancements there when we think about what's happening over the next 20 years. The advancements will be far beyond therapeutics. It's going to be into the food that we eat. We're already seeing that with like the Impossible Burger, which is very much like a hamburger, but it's all plant-based. The reason that tastes so good is because we're using genomics to make beets taste like blood. And so those are areas that I think are very exciting, that are things that are being discussed here in the Valley a lot, and areas that I think are really rich for investment opportunities.
So I think one question from the audience is actually very interesting, because I know your team located in California, and this is actually one of the competitive trends to getting to know the business. But the question is, some tech companies are leaving California for Texas. Could this be a trend for the next 20 years? Would you say that?
Yeah, and I think this gets to the second part of the question, which you had asked on the previous one, which was, it sort of bleeds into that, and that is, yes, California has very high taxes. It's a very expensive place to live, and so it is our belief that it makes a lot of sense that Silicon Valley is starting to broaden out beyond Silicon Valley. First of all, it has to. I mean, Silicon Valley it's a large place, but it's not so large as to be able to basically hold the world economy. It needs to spread out. I mean, I think it's healthy that it does so. And so, for example, the biotechnology industry really started in the Bay Area. But I would argue that it's the new heart, or it's really moved into Boston, Massachusetts area. Great universities there. And that's really where all the CRISPR companies are, generically speaking. And now we're seeing a lot of companies move to Texas. But we're also seeing a lot of really good companies outside of the US evolve. And so we are really open to that. We're seeing a lot of innovation with a company called C Limited, which is in Southeast Asia. We have a position in Adyen, which is a Dutch company, which is a payments company, which competes against Stripe, which many which many of the listeners might know. And so we also own a company called Mercado Libre, which is sort of a leader e-commerce down in Latin America. And so I think we will definitely see sort of over the next 10 to 20 years that this concept of Silicon Valley remains a concept. And I think Silicon Valley will still be incredibly relevant, but there's going to be many other parts of the globe that benefit from this innovation and create incredibly innovative companies. And we're aware of that and have our eyes open towards that.
It's a very beautiful comment. So some of the most powerful secular trends that you mentioned before, which accelerated during COVID, are going to look bad for a while in the near term when compared to their booming last year. For example, take online grocery delivery, for example. The pacing growth that we had in last year, where people are afraid to leave house and shop online, may slow down. Could this mismatch mean a good buying opportunity for investors? Do you have other examples where you see like small hiccups, but you have faith and conviction for as a ongoing trend?
Yeah. No, I think that's right. I think right now we're particularly like in e-commerce, they're suffering from what are difficult comps. But again, I think the way we think about this is like where was that change permanent? So I think online groceries is actually a great example. People 3 years ago were very interested or curious about online groceries, but it's just a hassle to put in what your favorite food is, what's your favorite kind of milk, what's your favorite kind of cereal, what your favorite chips are. And you have to sort of click all those different brands. And then, there's an indecision because you haven't tried it before of, of how does this get delivered to your house? When does it come? Is the produce really good? Or do they sort of pick out some of the worst produce because I'm not there? And I think those are like reasonable questions that I think were issues. And then the pandemic really spiked adoption. And so now we're seeing this sort of difficult comps, but from our perspective, that is permanent change. And what I mean by that is you might normally go to the grocery store twice a week. Now you're going to go once because you're going to have your sort of, your staples be delivered to your home and your heavy items maybe get delivered to your home. And so does that make for a 1 year difficult comp? It might, but it might lead to permanent change. We own a company called Shopify, and what they help is small businesses build an online presence. I would argue, there's something where if you were a small business, even if your small business ends up going under and you start a new one, you would never start a small business again without having an online web presence. You would have realized how important that is. But if it wasn't for COVID, you might not have ever built that website because there's an intimidation factor in building a website. And even though Shopify makes it incredibly easy for a small business, it's still something that's very intimidating. But COVID forced people and forced small businesses to really, create an online web presence so that they could stay alive and stay in business. And so that to us is an example of sort of permanent change that has occurred. So that's what we're trying to look for. An example of something not permanent change, in our opinion, would be like a furniture company that really benefited during COVID by, building home offices and desk delivery. And I would argue they had sort of a real spike. But then, 2 years later, probably the home office, trend is not as sustainable and probably never will be again. And so, that was a great spike of demand for a period of time while we were all building our home offices. And I would argue that might not have been permanent change. And so that's the kind of lens that we try to look through there.
So let's talk about the outlook for next year. What do you think that might be the biggest, variables?
Yeah, so when we're thinking about next year, there's a lot of different cross currents, and I think if you try to think short term, you can try to really, from our perspective, sort of try and work through supply chain, interest rates, inflation, and those are all really interesting topics. But in ones where we don't feel like that's where our competitive advantage is. Where we feel our competitive advantage is trying to say, what's moving forward and what's moving back. So I'll go back to sort of that idea of like those 5 platforms of disruptive commerce and genomic advancements and intelligent machines and new finance and exponential data, and try and find areas in there where, what is getting pulled forward, where demand's getting pulled forward because the technology is getting good enough and people want to adopt this new technology, and what's getting pushed back. And when I think about those over the next 10 years, I don't think it really matters what's happening in the supply chain or what's happening with interest rates. What I think will matter to drive the market over that longer term is, do there continue to be genomic advancements? Are we applying artificial intelligence to machines? Is automated driving really becoming a thing? Can we get to level 4? Can we get to level 5 automated driving? And those are the things that we're trying to look at. And when we look at the market sort of that way, then we continue to be very optimistic and think that this is one of the richest investing environments that we've seen in our career. And so that's what makes us truly enthusiastic, about investing in innovation.
Thank you. Thank you. I think, unfortunately, we have to stop here in the interest of time. A very big thank you to Matthew, portfolio manager, Matthew Moberg, portfolio manager of Franklin Innovation Fund. Thank you for being here with us on this insightful discussion.
Thanks so much for having me.
And so innovation is becoming a common investment theme with great storytelling power, where pandemic is the catalyst, but it goes beyond that. It is much more than just storytelling, and the idea conveyed there should help you to focus on trends of what you believe to drive the performance and to have significant impact on economies and business that would hopefully stand the test of the time. So I hope, if we have time, Matt, if you have time, I think, okay, that's a comment of a very kind comment from the audience saying thank you. So we have another question coming in. If you are up, if you still have time for one last question.
Sure.
Yeah. So the question is, demand of which innovative products or sectors you find the most attractive investment opportunities? What will be the driving factor for that?
Well, really, it comes down to the technology and the technological adoption, and is the technology there? So I think the way you sort of think about that is you can't have Snapchat or you can't have Uber until you have the mobility of the phone. And so that's why we sort of talk about these things in sort of these sort of platforms. And in that area, I spoke to it briefly, but if you're asking on a kind of 5 to 7 year time horizon, what are we most enthusiastic about? I think it would have to be genomics. We just think that's going to change the world so deeply and in such a positive way. That is just, and it's so much broader than what people expect. I think if I had to pick one, although we're very enthusiastic about multiple, I would probably say on the longer term time horizon, being able to map and change the gene will lead to tremendous advancements in human life.
I'm just glad it's not metaverse, because all I hear about my friends in the Valley, they're talking about metaverse. I've seen Free Guy. I just don't know what it is. I have to look more into that, I guess.
I think that's that'll be a 90-day spike. We'll see. I think a 90-day spike, but then maybe in the next 7 years or so, we'll be talking a lot more about it and know what it is.
Yeah. Okay. I think we have more questions are coming in, but don't worry, we will collect them and send it to Matthew, and hopefully he can get back to you as soon as possible. So thank you again. Thank you, Matt. And I hope you enjoyed our Portfolio Manager Conference today and leave better informed. Have a wonderful day and see you next time.
Thank you.
Bye now.